Hello everyone, I'm Roger Lissade and I love real estate. So welcome to my channel and let's get into it. So today I'm going to be discussing timing the real estate market. Now I know a lot of you guys have heard about timing the stock market, and let's open up and let's discuss what does that even mean, timing the market in reference to the stock market and then the real estate market. So when you try to time the market with stocks, you're essentially trying to buy when the stocks are at the lowest price and then selling when they're at the highest price. Now, here's the thing. I know a lot of people have tried to do this. You might even not know some people that are selling some program or a book or something that feel that they can do that. But when it comes to timing the stock market, I would make the argument that anyone that could do this 50% of the time, they're going to have a substantial amount of wealth to show that they can do that. Jamie Dimon comes to mind. He's a billionaire. Carl Icahn. A lot of the big boys that have made their careers and fortunes from time to market, and they openly admit that they're only right about 51% of the time, and they were able to do it. So that's timing the stock market, which obviously is also extremely risky. Involves a lot of different variables. You would have to understand the economy, the individual companies you're investing in, what affects those individual companies, and as well as understanding human behavior and human psychology. So why do I bring that up on a channel that I'm talking about real estate? Just to compare that to trying to time the market with real estate. All right. So once again, I'm sure everyone watching this right now is aware that there's been tremendous appreciation in prices all over the country. You may be in an area that you're seeing significant development and growth. So here's the thing, and once again, this is why I love real estate. Trying to time the market is trying to time the market, to me, the best analogy I could give you is trying to catch a ride on a train that does not stop when it pulls into the station. Let that sink in for a bit. Whereas trying to figure out what's going on in the real estate market is like coming into a race after the race has started, a race with people, but everyone's walking. So what do I mean by that? I mean that if you look at certain things going on in your area or the area you want to invest in, you can kind of backward rationalize why certain things are happening and then use that information to give you some insights about what's going on in your area. Case in point, I'm in Hollywood, Florida. I mainly follow what's going on in South Florida, which comprises Miami-Dade County, Fort Lauderdale, which sits in Broward County, and West Palm Beach, which is in Palm Beach County. So with that being said, let's look at a couple examples of what I'm talking about. All right, we'll start off with Miami. I just read on Next Miami today that there are thousands of units planned at Southland Mall, and it just so happens that that's next to a new mass transit, rapid transit stop that they're putting in. Now, I mentioned in the prior video how important it is that when you see certain changes going on in your area, that should basically light a light bulb over your head, letting you know that this area is going to be potentially a good area to invest in. And here's a perfect example. For any of you guys that want to look it up, Next Miami, just Google Next Miami, transit-oriented development, thousands of units planned to Southland Mall. Apparently, a developer who knew that this new rapid transit stop was coming into the area is making a bet, and $100 million bet to be exact. And he's going to buy the Southland Mall, and he's going to convert that to over 720 apartments. Now, the existing zoning allows him to build 15 floors. Of that, he can have 720 apartments. However, what these developers also like to do is when they're submitting their plans, or when they're submitting their proposals for the development, they will see, and they will hire lawyers, use their contacts to see if they can get the zoning increased so they could actually build more. Because they built the property, or I should say they purchased the property with the idea that at a minimum, they're going to be able to build 15 floors, provide 720 apartments, and they're going off of that when they ran their numbers. However, if they can get more, that would end up being more profitable for them. All right, so that's one example. Let's move on to the next. All right, so I'm sure you guys have heard of the big boys. Well, here's a pretty big boy. His name is Stephen Ross. There was an article in the Commercial Observer today about Stephen Ross' takeover of South Florida is all going according to plan. Now, for those of you who don't know Stephen Ross is the owner of the Miami Dolphins. He's also behind projects like Hudson Yards, which is the biggest real estate project in the country right now. And he's also in business with George Perez, which is known as the Miami Condo King, who has put up dozens, if not hundreds, of developments all through South Florida. So he's a pretty big guy. He's been heavily investing in South Florida the last couple of years due to all of the growth that we've experienced. And the reason that I mentioned him is, once again, remember what I said about trying to catch up to people that started a foot race after the race has started, but everyone's walking? I'm hoping most of you guys that see this video would be able to catch up to someone if you were able to run or jog or whatever, and that person was walking. And this is what I'm talking about. You could literally do a Google search of Stephen Ross real estate, Stephen Ross developments, and that'll give you a list of areas that he's invested in. And I know what you guys are saying. You guys are like, well, Roger, I mean, I did what you said. I Googled it, but he's building these $100 and $125 million developments. Roger, I only have 50 grand. Like, what does that mean to me? I'll tell you what it means to you. It means that either A, you look for smaller units within walking distance that you can potentially purchase. And if you're unable to do that, then the next thing you do is you look at adjacent neighborhoods, or neighborhoods that are relatively close. In other words, you keep going out in a circle from that major development, and you look to adjacent neighborhoods that haven't caught on yet. Maybe the people out there don't know Stephen Ross, or a big guy like him is investing half a mile from where they are. And you look to find opportunities in those areas. Case in point, the Miami Freedom Park, which is essentially David Beckham's project that he's been trying to get into Miami for, I think, about 10 years now, was recently approved. I predict that area, which is just east of Miami International Airport, it's going in the golf course. It's going to be built on what is presently, I believe, a golf course that is just east of Miami International. If you look on the map, that little patch of green right in front of Miami International Airport, just east of it, that's where the Miami Freedom Park is going. And I would say it's a relatively safe bet that once that's built, all of the real estate in that area is going to go up significantly. So for those looking to invest on more of a long-term basis, now keep in mind that, you know, a huge stadium, park, everything, it's going to take years for that to happen. Which once again goes back to what I said about trying to catch up to someone that started a race while they're walking. Guys, it's doable. It's doable, right? So that's one area. And obviously I'm more familiar with South Florida, but in your areas, start to become familiarized. Names like Stephen Ross, Sam Zell, and even some of the local guys in your area, start to become familiar with them, because you will find a lot of times just by following what they do or keeping track of what they do, that might give you ideas on where to invest that could be very profitable. Now, getting back to the original thing, you're probably saying, all right, that's all fine and good, but I wanted to learn how to time the real estate market. Well, folks, the answer, and I was hoping it might be apparent right now, is you can't really time the market, and anyone that could within short order would become, if not a billionaire, at least tens of millions, if not hundreds of millions of dollars within a few years if you could really do that. So the point I'm trying to make, or what I'm trying to do, is to give you the tools that can at least give you an idea. Because look, the biggest factor in any investment or asset is always going to be people. Perfect example. At the start of the pandemic, everyone thought real estate was going to go down. And why wouldn't have, right? They shut down the country. No one knew what was going to happen with the pandemic. Did we know? I mean, it could have been something way worse than it was. Last time we had a pandemic, Spanish flu. I forget what the worldwide total was, but I think it was way more than died in this one, and people thought that might have been a repeat. Thankfully, that didn't happen. And what ended up happening is the exact opposite of what everyone expected. Real estate skyrocketed. I mean, there are definite reasons for that, but that's what happened. Now, on that train of thought, and I might beat this to death, I'm going to say it again. I get people asking me, if I, should I wait until a crash happens? Or real estate can't just keep going up. It has to come back down at some point. Well, here's the thing. The prices we're seeing right now in real estate, they're that way for a few different factors. The biggest factor is that supply chains are still constrained. When they shut down the economy during COVID, they broke very complicated systems that have not returned to full strength yet. Some are predicting it might take another 3, 5, or even 7 years. Some are predicting they may never come back to full strength. And the reason that is if you think about it, when they shut down the economy, a lot of businesses had to close. A lot of people with the expertise of how these systems ran and operated, many of them had to move on for obvious reasons, right? I mean, if they're not working, they still have to find a way to feed themselves and take care of their families. So they moved on, and with that, they took a lot of expertise with them to other areas, other companies, maybe even other career fields. So unless there was a way to get everyone back and put them back into place, supply chains are going to be constrained for a while until new systems can be developed, new technologies, new ways of doing things, as well as unclogging the backlogs that we have. So that's number one. And that is feeding in to the demand that we have right now. Currently, right now, we have more people looking for homes than there are homes. And I know some of you guys are thinking, well, they just raised interest rates, they're going to keep raising interest rates, isn't that going to help? And yeah, that definitely is going to help. However, is it going to eliminate the excess demand? From what I'm seeing, no. I mean, real estate definitely has slowed up a bit, as in the sense that prices are not rising as fast as they were. But we're still in the same situation of there's more people looking for properties than there are properties. Now, another thing with rising real estate, rising interest rates, a lot of people assume that, hey, it's going to get rid of a lot of buyers, which is correct. It definitely will. However, the problem becomes rising interest rates means that that's going to be an added cost to the builders of single family homes, multifamily, etc. And the way builders typically price that is to pass it along to the consumer, which usually means they build more expensive homes and more expensive units and multifamily properties. So that leads to less inventory, which also leads to more demand. The war in Eastern Europe, Ukraine and Russia. Russia apparently provides 17% of the world's nickel, or a type of nickel that's used in the production of steel. That raises the cost for the builders, which means they're going to produce less, which means more demand. And let's not forget that every month there are more and more families coming online, more people looking to move for various assortment of reasons. So demand is always going to be there, guys. Well, let me not say demand is always going to be there, but for the foreseeable future, the demand is going to be strong. So what does that mean to you guys that are looking to buy for yourselves, that are looking to invest? I would say waiting until a crash or a correction happens is the wrong strategy, because, and here's why. And I'll keep the math simple. Let's say right now you could buy a home or an investment property for $100K. And let's say you wait until the crash because you're like, well, it's overpriced. I'm not going to do that right now. All right. Let's say you wait 3 years. And during that 3 years, that $100K home, 2 years from now, went up to being $300K. Then this crash happens. The crash causes the house to go back down to $200K. Now, hopefully most of you guys have figured out that $200K is more than $100K, right? Now, here's another factor. Although I can't tell you what interest rates will be in 3 years from now, chances are they're probably going to be higher than what they are today, which means that even if the house was the same exact price, it would cost more for you to have that house with higher interest rates. So what is an investor to do? What is a homeowner to do? Well, the bottom line, guys, is that when you're looking to purchase what for most people will be their largest assets, you've got to look at the bottom line numbers and let that guide your decisions. Like I always say, the numbers and the data is what you need to pay attention to. Not what the catchy headline is, not the fear index, not what Cousin Jimmy has to say about it, or even your own personal feelings. Because let's be honest here, sometimes, if not a lot of the times, emotions and feelings can be wrong and mislead you, especially when it comes to finances. So I'll leave you guys with this. Definitely pay attention to what's going on in your neighborhood. Definitely pay attention to the big boys. If there ain't things that are going on, like they're putting in rapid transit, and that could be either bus or rail going to, that's always a great sign. If you see neighborhoods that have attracted big developers, even if you can't particularly buy in that specific neighborhoods, look at the adjacent neighborhoods, look at neighborhoods that are within a short commute or short walk, and just see if you could find something there. And that's a great place to start. Sometimes you can even find a home that you might want to live in, or a home that you might buy, fix up, live in, and then end up renting out down the line when you find something else you want to move into. But anyway, guys, I hope you found this video useful. If you do, please give me a like, subscribe, and share with your friends. Anyway, guys, I'm out of here. Have a good one.